Welcome them all. Jamie Cox is here in studio. He's Harris Financial Group's managing partner. Also with us, Subhadra Rajappa, Societe Generale's head of U.S. rate strategy, and Bill Lee, Milken Institute's chief economist. Welcome all of you. Jamie, which camp are you in?
I'm in the do not hike.
Really?
Do not terrorize the banking system anymore. I mean, we're on the precipice of maybe getting into the meat of many of the regional banks. So the Fed has the ability to kind of fix the problem that it has created. If you think about it, the overnight reverse repo facility now takes in $2.2 trillion. That's actually more than the GDP of South Korea. And that could be fixed very easily by the Fed reducing the rate it pays on those the reverse repos from 10 basis points to 25. They could restore deposits that are actually been running out of the banking system and actually restore some stability. And at the same time, they could also stop cutting rates. They really need to, or else we're going to be in really big trouble with regional banks.
But let me ask you, I mean, did the Fed cause the banks problems, or did bankers cause the banks problems?
I think the Fed is directly responsible. I mean,
but it wasn't the Fed that caused those bankers to load up on long-term treasuries, and it wasn't the Fed that was engineering that or keeping deposit rates low.
If you go back to 2019, when Jerome Powell pivoted, we basically flooded the system with reserves, and those reserves had to be dealt with some way. So what banks did is they invested in treasuries, that high-quality asset. And then they did it again and with persistent through the pandemic, persistent reserve increases, all right? Well, now they raised rates really, really fast and basically buried the banks and made them technically insolvent. So it's a problem the Fed started. It's a problem the Fed has now created a big mess with, and it's a problem the Fed can fix. And they need to do it before it becomes an even bigger problem than it already is.
One more point on this before we move on. But, hey, the regional banks are green today. Problem solved. What do you make of this erratic trading behavior where yesterday we saw tremendous declines, and today we started out that way, and then the tone changes into a Fed decision, no less?
For the past, I don't know, probably 3 to 4 weeks, you've seen this back and forth. You know, multi-high percentage point gains and losses day by day. That's not normal in banks. It's not normal in any high-quality asset. And that tells me that there's a big problem that needs to be fixed. So to me, I think they need to deal with it before it becomes a problem. And larger, think about it, one last thing. $500 billion of banking, problems. It's bigger than the global financial crisis. We had 3 banks represent a bigger hole in the financial system than we had during the financial crisis. That is only going to get worse.
Bigger than 2008. Yeah,
exactly.
Absolutely true. Let me turn to you, Bill Lee, and get you to give the rejoinder to Jamie. You're on the other end of the spectrum. You think the Fed will do 25 basis points or a quarter point, but you think they should do 50. Why?
We don't have a banking crisis. We have a crisis in bank supervision. We allowed the supervisors have allowed these badly managed banks to continue when they should have shut them down. And let's remember, banks account for only 11% of total corporate financing. Yes, banks are incredibly important for small businesses, and that's where we think the channels are really going to hit. The Fed is worried that we have too strong an economy because consumption remains too strong. Investments turned down, the real estate is turned down, but consumption is not. And why is that? Because the unemployment rate is still 3.5%. People are not worried about their jobs. If we do have small regional banks start to contract their loans, and that will hit small businesses the most, and that will hit the labor market. That will finally get inflation to start slowing down by slowing down consumption. So the channels for monetary policy transmission are going exactly the right way if we allow the banks to contract on their loans. Now, to get rid of inflation, we, I think, need a little bit more tightening to get people to stop spending so much. So if you look at Taylor rules or other reference rules, they're calling for 6%. So for me to say another 50 basis points is warranted is really somewhere between where the market's pricing and where these rules are pricing.
Back to the point on banks, do you think we have a problem with regulators or regulation? In other words, are the rules wrong, or is the application of the rules insufficient?
Bingo. We have a crisis in supervision. We have a lot of rules, and the rules are designed to look at the banks that are the most systemically important ones and look at them carefully. The ones that are smaller, they pay less attention to. The banks that fail put a hole in the banking system in cryptocurrency areas, in Silicon Valley, venture capitalists, and among very rich people at First Republic. These are very, very narrow-focused banking models. regional banks that help small businesses, community banks that help minority businesses, they're still doing very well. What is a shame is that the Federal Reserve didn't come out and say, our supervisors fell on the job, and we're going to fix that, and we're going to make sure that every bank that's out there is doing the job well, and if they're not, we're going to shut the managements down. If we did that, we would calm the markets completely.